show today. We have James Gellert, the executive chairman of Rapid Ratings. We have Jay Edlin from Wove, the co-founder and CEO, who will be with us in studio talking tariffs. We get to talk the AAR numbers with Bill Stevens. The rail report will be out any minute now today. And we also have Jeff Anderman, the CEO of STG Logistics, to talk about their emergence from Chapter 11. So overall, really a great show in store for you all, and some really interesting news to talk about as well.
You know, Julia, it is earnings season, and just, I think, a contrast of two mid-size, large. I mean, they're large, they're mega truckload carriers, but in our world, they're a bit smaller than some of the other companies. One is
Billions,
Pam.
not billions, yeah.
Pam had a 110 OR, 114 on their truckload operations. And then Heartland, we didn't talk about last week, is back to profitability. One of the consistently up until the last couple of years, one of the most profitable brands out there. Now is back to a 90 OR.
Yeah, it's great. So they were historically known to have an amazing operating ratio, right? One of the most profitable carriers, Heartland, that is, that I'm talking about. But then certainly struggled after some acquisitions. Q4 2024 popped back barely close to profitability at a 99.6, but then huge improvement to be back in that low 90s.
Yeah, for sure.
This quarter.
So we're going to get into it. Let's get to the headlines.
We kick things off with a brutal reality check from the truckload sector, where one carrier's struggle to escape the red is stretching into its second year. Kamp Corp reported its seventh consecutive quarterly net loss on Tuesday evening, booking a $7.4 million loss in the second quarter. The company's truckload unit posted a staggering 110.6% adjusted operating ratio, marking 11 straight operating losses for that division. To restore profitability, Kamp has aggressively slashed its fleet count to just under 2,000 tractors, down from over 2,400 units 3 years ago. However, there are emerging signs of relief. Revenue per loaded mile increased 4% sequentially from the first quarter, and President Lance Stewart noted that, for the first time in more than 3 years, market conditions enabled a meaningful sequential increase in rate per total mile. The company is betting that constrained driver supply will unlock further rate correction opportunities ahead. Over in the specialized bulk sector, a major acquisition is reshaping the food-grade transportation landscape. Canadian bulk hauler Trimac Transportation announced Tuesday that it has acquired California Freight, a bulk food-grade logistics provider operating 8 terminals, a warehouse, and a brokerage office across California and Nevada. California Freight brings approximately 500 tractors and tank trailers that ship raw milk to processing facilities, along with over 400,000 square feet of food-grade storage space. The company has been serving food and agricultural companies across California's Central Valley for 3 decades. Trimac President and CEO Matt Four stated that California Freight's capabilities in food-grade transportation, warehousing, and brokerage align directly with Trimac's long-term growth strategy. California Freight will continue operating under its current banner, with Trimac executive Jesse Hansen taking over as president. Finally, the legal battlefield over shipper liability just scored another major victory for shippers in a Texas appeals court. The Court of Appeals for the 8th District in El Paso upheld an earlier decision blocking vicarious liability claims against aircraft manufacturer Atlas Aerospace, whose freight was being hauled by Dorados Trucking when it was involved in a fatal 2018 collision in Kansas. Judge Gina Palafox wrote that the plaintiffs presented no evidence sufficient to raise a fact issue on whether Atlas exercised any control over which trucking company was hired, which tractors were used to haul the trailers, or which drivers were selected. This marks the second recent Texas court decision rejecting shipper liability. Meanwhile, C.H. Robinson remains on the offensive following the massive $604 million Leip versus Lupus Superior verdict against it, publishing a question and answer document this week, reaffirming its determination to appeal and refuting industry rumors about the 2021 crash.
Now, Julie, this whole shipper liability thing in Texas, this is the second one. One was Home Depot with Warner. Warner was selected basically, and it went to the Supreme Court. Home Depot was on appeal, was absolved of any liability. And then you now have this other case in Texas. Feels like that's a really nice protection for shippers.
It really does, saying that they can't, control the carrier that's selected the driver or the equipment, right? The truck does feel like a lot of protection for
Shippers continue to win
shippers.
victories in Texas. It is interesting
The flip-
because the C.H. Robinson case that this lupus superior case that has gotten a lot of attention. The question is, how is Texas going to rule in terms of whether first of all, was the driver an employee? I don't buy that argument. Matt Leffler and I talked about that on Freight Expectations last week. But then there's also, what is the liability potential? It just feels like that one's going to get thrown out on a pill. I
feel like it
have a
has
hard
as
time
more
believing it's
details
going to
come
stay.
out. You know, we had originally said that the C.H. Robinson employee knew that the driver wasn't feeling well, but more details have come out, and it sounds like that was kind of communicated through their dispatcher, and that the load was still rescheduled. There's a lot there
But
that it feels
there's
like they
no
did
word.
what they could.
So from what I understand, is there was no confirmation that C.H. Robinson had any contact with the driver.
Right.
And so how are they an employee? Makes no sense to me. And I think the appeals court will hear it, and we'll see where that ends up. And of course, this is something we will talk about over the next couple of months and years, because it's definitely going to be there. I want to get back to the conversation about Heartland versus PAM.
Well, and I think there's a good tie-in here. So one of the things in the PAM earnings was that they did go ahead and accrue $3.1 million for prior liability claims that they thought might continue to come up exceeding their insurance levels. So it's another example of verdicts like this, liability regulation, creating more pressure for carriers and brokers.
Why is PAM operating at a 111? I mean, Heartland had a couple of years of struggle after its big acquisition binge that have taken place over the last couple of years. Heartland is back at a 90 OR. PAM is at a 111 in this market.
And they've shrunk truck count.
It
to try
tells
to
you
improve.
a lot about, I mean, is it the automotive? Like, what is going on? Because PAM's got all this exposure to the automotive sector. It just feels like this is a carrier. I mean, they in the press release, they talk about their balance sheet, the fact that they've got the capital to withstand some of these losses, but you can't operate indefinitely at losses. And we've seen companies in the past, and we sell it on as an example. Of course, there's some accounting irregularities, not the case in PAM's case. I go back to years ago. This would be when I was a teenager, a company called Cannon Express. Do you even remember this company?
No.
Based in Arkansas. Walmart was their number one customer. I think it was 70 to 80% of their business, Cannon. And there was a change in traffic management at Walmart. They lost some of their business because they had high such concentration for it. And they were sort of a bottom feeder. Cannon went under. It was a publicly traded company that went under because of it. It had high concentration, low rates. And this sort of feels like what PAM is going through. PAM has such high concentration with the automotive sector, and specifically, the big three, that it is having a problem really sort of dealing with these issues.
Yeah, I researched that a little bit this morning because I was trying to figure it out as well. About 35% of their business is automotive, and then they do some manufacturing, which you would think would be, CPG and manufacturing. But I think it's like HVAC units and a lot of things that might be slow right now due to the housing market. I don't know, but 114 OR for truckload.
No,
they actually made money in logistics, 96.4. Total miles up, total loads down, truck count down. But what revenue per total mile was down. I bet you couldn't even guess what their number was.
Revenue per total mile, $2.
198, down from 204.
Wow. In this market.
To me, that's the number.
Now, a lot of it is those particularly automotive, those automotive contracts are really multi-year agreements. There's been some pressure. They may have tried to get some market share during the Great Freight Recession, but they have certainly not positioned themselves to withstand it. And I think Heartland deserves a lot of credit here. Yes. Heartland is back. Welcome back, Heartland, to putting up some good numbers. You're at a 90 OR. We're proud of you for doing what you need to do. It's actually for a truckload operator, that puts them in the best class. I mean, they have, even we had coveted on David Parker, my uncle, 96, not great. It's an improvement, not great. But 90 OR is really what you would expect from Heartland. It feels like they're back.
And the 96 made sense because there's a bit of drag in logistics right now. We know brokers are under pressure. That's why this PAM is so surprising.
It's really
to me. Their
strange.
logistics OR was better than their truckload OR, which we know truckload is hard, but I haven't totally there was a lot in it that I couldn't reconcile. Revenue per truck per week was down, but they also said miles per truck per day were up. So and that their empty miles improved.
They've had some turnover in management. CEOs have turned over a few times. I mean, it has been a story that I think we're continuing to follow. And there's some, closely held ownership. The folks that own the Ambassador Bridge is the same sort of family that owns, has a controlling interest, public traded company, but a controlling interest in PAM. So again, a lot of that's going back to the automotive sector. And so, it's going to be interesting to watch, but I'm happy to see Heartland back.
Yeah, me too.
Just because they're such a story company that consistently put up numbers.
Yeah.
An impressive turnaround from it's been a couple of years where they haven't really been doing well. So it's great to see that they've been able to absolve the transactions, consolidate. They rebranded the old CFI. Growing up, CFI was my favorite non-US Express company because they used to do the spot. You remember the 7-Up spot? Do you remember the dude that had the arms and it was like the dot? You don't know what I'm talking about. Maybe the young kids or the older people, you're too young. But the 7-Up had this spot, and it was and so somehow CFI got this brand, and they had the thing. It was like a voice.
So they had a cool logo.
They had a cool logo, and they had beautiful red Kenworth trucks. Yeah. They also dominated I-35 with Celadon, rest in peace. But it was interesting because US Express and Covenant and CRST dominated the east-west. CFI and Celadon dominated the north-south. Actually, PTSI, PAM, also is historically a north-south carrier. Taking automotive freight from Detroit into Mexico, has at least historically has had a lot of cross-border freight. Not doing well. We'll pay attention and see what.
Oh, they found it.
You don't remember the spot? There's all these commercials about the spot.
I don't know. Whoever's a genius and came up with that graphic so fast can tell us what year it was, and then maybe that'll be why.
It was the 90s. You don't remember it? We should find a photo, Fraser, back there to the old CFI trailers with the spot behind its wheel axles, because that's what it looked like. Our first guest is James Gellert. He's executive chairman of Rapid Ratings. We're going to talk about the financial sector. Rapid Ratings provides market transparency and financial health across middle market and private companies. Welcome, James. How are you?
I'm doing well, Craig. Julie, good to see you. I like the segue of looking for someone who is old enough to remember the spot.
I'm so glad you do. Do you remember the spot?
Right to me. Yep, I remember.
It was the 90s. The 90s were great. It's sort of the Sprite 7-Up wars.
Yeah, I remember
the Cola
that,
wars.
But I don't know.
The Cola wars were cool. They were not as cool for a freight guy as the parcel package wars between DHL. It was really FedEx and UPS, but DHL sort of showed up. In fact, there was great commercials of that when Pepsi and Coke were sort of there, where the driver was secretly drinking. I think it was Pepsi. So James, tell us all about Rapid Ratings.
Sure. So first of all, it's great to be with you, and looking forward to talking today. Rapid Ratings is a financial analytics company. We specialize in providing financial health ratings of public and private companies through an algorithmic process that gets used across many different use cases, but the largest are companies using us to understand their suppliers and their supply chain as deeply as possible. And of course, financial risk is one of the underpinning elements of how companies are performing. So all business outcomes, positive and negative, almost always stem back to whether someone is financially capable of living up to their agreements, their expectations, delivering things on time and in quality, with high quality and so forth. So we represent companies across about 27 different industries globally. We rate public and private companies, with private companies from about 170 countries. And so through this data, we get to see an awful lot of what's happening across industries and upstream into lots of categories of supply chain.
So James, what is it that you guys do that is special? I mean, at least public data, anyone could sort of get that data from the public filings. But what is it? What's special about your data set that someone would be using to really understand a business?
So I guess there are a couple of different ways of looking at it. The analytics themselves are probably the most sophisticated, commercially available modeling system for understanding what we call financial health, default risk, credit risk, future financial performance are all different ways of looking at basically the same kind of thing, which is how strong is a company. Our system is very sophisticated, looks very deeply at companies, allows you to look at public and private companies on the same basis across any industry, large or small, and from anywhere in the world. One of the applications for the sophistication of the modeling is being able to put in private company data. And that, of course, is where many companies fall down and have a very difficult time when looking at their counterparties. It can be their customers, but predominantly their suppliers and other third parties. So we have a process to reach out to private companies to obtain their financials on behalf of our clients. And we've now become the trusted player in this space. So many private companies come to us and want to be a part of this network. So as we have more and more industry concentration in industries like autos, like you were just referring to a few moments ago, we have a considerable amount of data in the auto supply chain across lots and lots of different components of it or sub-industries of it. So the special sauce, if you will, is a combination of the ability to get private company financials and being trusted to do that. And then also the analytics that come out of that are different and highly predictive. And we've been extremely successful in identifying risks and problems that have emerged with companies for many years now.
So James, in terms of size, is there really, small companies are notoriously, that's where a pretty significant black box is. Maybe the risk is higher if you're bigger because you're just a bigger customer to somebody, perhaps a bigger vendor to someone. But is there a size cutoff in terms of where you guys really focus?
There isn't a size cutoff, but you are right. There are certainly idiosyncrasies to smaller companies and larger companies. I would say the easiest way to think about it is the larger companies have, generally speaking, more diversity of clients. They may have larger supply chain bases and therefore take on more risks in their supply chain. But also they have a very different access to capital than smaller companies do. Not just being in the public markets, but there are a lot of different ways that public companies can raise capital that private companies can't. So the illiquidity in the private market, the fewer sources of capital, mean smaller companies and private companies will be buffeted around more by changes in macroeconomic conditions, geopolitical conditions, and then, of course, their own financial strength. So when people are looking at suppliers and trying to understand the resiliency of the supply chain, private companies are a particularly nuanced element of that, and generally speaking, represent about 75% of most larger companies' supply chains. So as go the trends and the factors that are affecting private companies, ultimately goes the overall strength and resiliency of a broad supply chain and ecosystem.
Yeah, I know that companies, we see it in our own customer base, have really stretched payables in this sort of higher interest rate market, started to slow, maybe in sectors, a slowdown in the economy. But one of the ways to sort of generate or hold on to cash longer is to just slow pay your vendors. Are you guys looking at that as a sort of a sign of overall health, or how do you think of it?
Yeah, certainly. We look at how quickly companies are paid, how quickly or slowly they pay. And that cash conversion cycle is a very interesting window into how companies are doing from a variety of perspectives. And what we've seen right now over the last few years is continued pressure on the middle market. So companies that are sort of 750 million in revenue and lower. And the pressure that they've been under from a top line perspective, as well as from a cost perspective, has been compounded by the fact that larger customers of theirs have been paying slower. And the private companies, those middle market companies, are generally speaking still having to pay their suppliers upstream at an accelerated pace. So those middle market companies have had cash conversion cycles, depending on the industry, gap out over the last few years, almost a month So 30 days longer that they've had to manage their own working capital while getting paid later by larger companies that have basically been able to extend payments, generally speaking, because they're stronger. So we're seeing this as a factor and as a concern, and certainly something people should be looking at. We're also seeing more of the more sophisticated, larger companies looking at ways to help manage the working capital of their own, but also the working capital of their primary suppliers.
Yeah, I mean, I think of bringing that specifically to our audience and thinking about that, we have a full sit rep on pay terms from shippers and what that means for carriers kind of by size and how that creates pressure for them. So certainly something that's important. But you've said that financial health really across that middle market and private companies has been deteriorating since 2019. Can you talk about the factors that are leading to that?
Certainly. So the COVID period was an interesting one because it obviously affected all companies, different industries, different ways, but it basically affected all companies. And a lot of the period coming out of COVID for many was relatively stable, particularly given if they had to borrow capital, the cost of that capital was quite low. So interest rates were low. Inflation hadn't fully kicked in. And the period post 22, we've seen more inflation and consistent inflation. We've seen higher interest rates, higher labor costs, and so higher costs of goods through broad inflation. And then when you throw tariffs in on top of it, you've not only had higher cost of many goods and services, you've had the volatility and the unknown that companies have had to navigate through. So that has put a tremendous amount of pressure on the companies that are borrowing in floating rate, which most private companies will be, as opposed to long-dated bond issuers in the public market. And so they're paying more, sort of across the board. They aren't necessarily able to charge more or pass those costs through. So many companies have had to be the shock absorbers in the market, keeping those or having the erosion in their operating margins. Then on top of that, they've been borrowing more. So you've seen a significant increase in leverage, a reduction in interest coverage, and erosion in both operating and net margin. So it's really put a lot of strain on the middle market over the last few years.
And are those sort of the same reasons that are causing private equity firms to hold on to these companies longer than maybe planned, or dragging out that exit?
That's certainly a part of it. A lot of private equity firms have been able to rely on the improvement in companies, but also the improvement in multiples on pick a measure, revenue, EBITDA, whatever it may be. There's been a compression over the last few years in those multiples. And then with more AI concerns coming in and the advent of AI in day-to-day use, we've now seen multiples on particularly SaaS companies get really crushed quite hard. So the combination of the overall market for companies that a lot of private equity firms bought, let's say in 2001 and 2002, with higher multiples, now being in a tighter multiple environment when these companies are struggling more in a lot of operational respects. So that has elongated the hold period. So a 4.5 year average, which going back over the last 10 years is probably a good benchmark for private equity holds, is now more like 6 or 7 years, depending on the sector. So the companies are holding these companies longer, looking for exits, and needing to find more ways of creating operational improvement in those businesses while they're holding them.
So James, SaaS multiples have been compressed due to this AIification, investment cycles, some fear that the SaaS apocalypse is upon us. What are you seeing right now? I mean, it's going to make it more difficult talking to venture capitalists. They don't really want anything that isn't AI centric. I think every startup has repositioned themselves as an AI first company, which most of them probably aren't truly AI. But what does that do for overall sort of state of SaaS businesses out there? And how are you thinking about sort of the risk profile of these companies?
Well, let's face it. AI is neither categorically wonderful or categorically bad. It is about how it's applied, where it's applied, and the efficiencies that can be brought to running a business because of that AI. So what's incumbent upon every business is trying to understand how they can create more efficiencies through using newer technologies, and that's going back to any technology and technological revolutionary period, the internet itself, for instance. But the opportunities with AI are going to be capitalized on, and management of businesses need to properly express to their clients, to their suppliers, to their stakeholders how they're using that AI and how they are going to be creating a roadmap of value for all of those stakeholders going forward because of the AI. So again, it's neither good nor bad. It's another technology that creates a lot of interesting opportunities, and businesses are going to adapt. And certainly some businesses will change. The fundamental objective of a business to be profitable and to generate returns for fill in the blank shareholders, it doesn't change. It continues, and it is one of the most fundamental parts of running a business and evaluating a business.
But James, a lot of the venture-backed companies, they got the benefit of very high valuations in 2021 and even just around that sort of bookended in that sort of period of time. With the idea, I think VCs were largely believed that private equity, they could sell it. Again, all these institutional capital investors are sort of selling it to themselves and sort of trading up. But that window is closed unless the business, as you mentioned, has significant cash flows. A lot of private equity firms won't touch it. What happens to all of these venture-backed companies with high multiples where, are we going to see a re-rating of multiples for these VC-backed companies? Are we going to see investors hold on there for continuation funds? Like, what is the prognosis for a sort of overinflated venture-backed technology businesses?
It's multi-layered, and it's a real challenge, particularly for supply chain managers to understand the businesses that they're working with. And many of the companies that are in people's supply chains fall into this category, whether it's venture or growth stage private equity. A lot of these companies are going to evolve. They're going to evolve perhaps in ways that they wouldn't have if the environment was different, but they are going to evolve. Many of them will become more efficient. They'll become smaller. They may be focused on fewer things. Some expansion plans that they may have had may get pared back. We're likely to see more M&A. This is a very interesting opportunity, this period, for strategic investors to buy middle market companies that may be in that private equity hold period towards the end and getting a little stale from that perspective, but sort of too soon operationally or improvement-wise to be flipped to yet another private equity firm, or as you brought up, a continuation fund. So we're going to see more of these events, but we're also going to see more challenges for these companies. Those that are indebted, that have borrowed, are in a tricky time because it's very difficult for the weaker companies to refinance. Many of the companies are having to negotiate with their creditors to get extensions or waivers or other negotiations for relief. So we're going to see more bankruptcies. We're going to see more restructurings, or maybe even better yet, you won't actually see the restructurings, but they're happening. But one of the big keys here is that we're going to be in a period for an extended time where strong, mature risk management of supply chains is going to be absolutely essential for people to understand the risks to their own business.
So what is your advice to founders that perhaps raised at high multiples during the sort of heyday? Is it get to profitability? Like what should they do in terms of positioning themselves best? Is this going to be a situation where these businesses, the founders hold on to them forever and institutional capital just has to sort of ride along? I mean, we've seen Bending Spoons as an example. It seems like they've gotten some great deal of buying some, subscription-based businesses, technology businesses that have perhaps sort of peaked and are now on the decline. Like, what's the prognosis for these businesses?
Well, look, I think some of these businesses are going to have to focus on better defining what their value proposition is, better defining what their objectives are, and then marching towards achieving them in a milestone format, as opposed to saying everything's going to be a moonshot for the next couple of years and come back and look at us then. So there's more scrutiny on these businesses. The opportunity, I think, from a communication standpoint, is really fantastic, because these businesses we're talking about are trying to sell to, or do sell to, larger companies that know or are already doing more risk management of their suppliers. So this is an opportunity for communication, for transparency, for collaboration, because the large supply chain organizations really do want this from the private companies, and the private companies have an opportunity to not only comply when asked, but to be forward-looking in communicating how well they're doing, or how they are meeting goals and creating objectives and marching towards them. That kind of collaboration and transparency creates commercial value. I think the stronger private companies are the ones who are going to capitalize on that the best, and the strongest customers of theirs are the ones who are going to require it and really appreciate it when it's done proactively.
Yeah, I think there's so much to watch here. James, really appreciate your time. Thanks for coming on FreightWaves Today, telling us, look, supplier vendor risk is a big issue, Julie, as companies are evaluating. I think in logistics especially, like, it's something we've talked about, is the public companies have the advantage in some ways in this market, particularly the public brokerages, because their financials are transparent. Shippers, when they're underwriting suppliers, at least know that information.
Yeah, I absolutely think that's true. But I think there's also risk in technology vendors that brokers, for example, are using as well, and what's going to happen there if they've built their systems and processes around that. And
We have yet to see, though, I think it's one thing to have a very small tech vendor, but if somebody has subscription revenue, I can't imagine that they wouldn't get picked up in an acqui-hire. Like, I don't think subscription businesses just suddenly shut down. Somebody's going to want those pieces. If you have subscribers, you have an exit. Not a great outcome for the founders or the investors, but at least there's a home for you. We'll be right back. We're going to talk Sonar. It is LMI Day, in addition to AR Day. We're going to get into the Logistics Management Index and what it tells us about the freight economy after these messages.
The drivers, dispatchers, mechanics, and crews who keep the world moving deserve tools that work as hard as they do. That's what Samsara builds, technology for safer, more efficient operations, made with the people who do the work. Samsara, built with operators for operators. Learn more at samsara.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D, to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network. Billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days. Founders, executives, innovators, and disruptors all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business: the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head-to-head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Welcome back to FreightWaves Today. It is LMI's, the Logistics Managers Index. It's the time when hundreds of supply chain managers tell us what their expectations are over the next month. Let's get into the LMI with Julie's Sonar update.
So for today's Sonar update, August 5th, Wednesday, I want to talk a little bit about the overall market and then about the new LMI report that just came out. So overall market, truckload rejections, our STRI.USA index has fallen a bit to just below 14%. We're at 13.84% tender rejections, which is down 2.74% month over month. However, when you compare it to prior years and normal seasonality for late July, early August, we're still extremely elevated from what we have seen over the prior few years. We're seeing the same for NTI for spot rates. That NTI.USA is down to $3.47, which is down about 7.5% month over month. However, again, very normal seasonality and still extremely elevated compared to the last 3 years. The other thing that I want to call out is that truckload contract rates are VC RPM1.USA, which is currently sitting at 271 plus fuel, is still up 18% year over year. So it stands to reason that as contract rates rise, mini bids and new bid cycles are executed, that routing guides are standing up, more contract freight is being accepted at those newly agreed upon increased contract rates, which then causes those tender rejections to normalize a bit and fall. So again, everything that we've said in July remains true for early August. I do believe that as we get into the last week of August, we will see capacity continue to tighten with road check and other safety enforcement going on, as well as leading us into what I believe will be more of a normal peak season as we head into the fall. I also really want to talk about the new LMI numbers. We'll get significantly deeper into this on the second half of the show on Thursday for the Freightonomics segment, where we will have Dr. Zach Rogers on with Zach Strickland to talk about this. But the July numbers are out. The LMI overall number for July is 68.9%, which is down about 2 points
from June, where it was at 71.7. However, the projected direction is expanding, but the rate of change is slower than what we have seen. Inventory levels are also down to 55 from June, where they were at 60.5. However, the projected direction is expanding and expanding at a faster rate of change. With inventory levels continuing to fall, we should see a restocking and replenishment at some point going in again to a normal peak season and into fall. Inventory costs were up about a point in June. They were 75.9 up to 77 in July, with that direction still expanding. Warehousing capacity was down about a point as well, from 47.5 in June to 46.3 in July. Warehousing utilization also down about 3 points, from 69.4 to 66.1 in July, while the warehousing pricing is still rising. It showed 73.8 in June and is up to 75.5 in July, with that direction showing as expanding and the rate of change as faster. Transportation capacity also fell from 30.8 down about 2.5 points to 28.4, and showing that direction of change as contracting, so capacity continuing to contract and at a faster rate. Transportation utilization was down the most significantly of all of the numbers, from 74.7 in June down to 65 in July, with that direction of change showing as expanding and the rate of change showing as slower. Transportation pricing did fall, which is right in line with our NTI and what we just discussed, from 92.4 to 86.9. However, the projected direction is expansion, but at a slower rate. And then the aggregate logistics costs also fell slightly, from 242.1 in June to 239.5 in July. However, that projected direction is showing as expanding but slower. So overall, again, that July LMI number is 68.9. That's the Logistics Manager Index. The average for the last 3 readings was 69.8, so we're just slightly below that by 1 point. The all-time average is 61.7, with a high of 76.2 and a low of 45.4. So when you still think about that overall average as well as that low, we're significantly above that. All indicators of a pretty healthy freight market. Again, we'll dig into the details a bit more on this tomorrow, but wanted to go ahead and get those numbers out and in front of you all. Again, you can access all of this LMI data directly in Sonar, as well as accessing the full report directly from the Logistics Manager Index, but the executive dashboard in Sonar gives a really nice, quick, clean snapshot as well of each month's numbers.
So Julie, another great report just showing how tight this freight market is and really inventory levels. Was interesting that inventory levels, I think, are dropping a bit in terms of just the overall level in terms of inventories aren't building as much. And it's sort of, if you go to Gene Sirocco, like what his comments were, that retailers are pretty bullish on the second half. I mean, any thoughts on that?
Yeah, I think that people were hesitant to see what was happening in this cycle, but now I believe that there's going to have to be a replenishment in those inventory.
Yeah, it says expanding. Those inventory levels, according to the LMI, are actually dropping. I think that's an incorrect statement. It says expanding there.
It says the projected direction will be expanding.
Projected direction. Okay.
So it dropped from 60.5 to 55. So it dropped a little over 5 points.
5.5%, yeah.
But
the projections are it will expand in the future.
It will expand,
okay, got it. I mean,
and
it makes sense. You're going to the holidays.
Costs are still up, right?
You're going to the holidays, and so you're going to naturally have more inventory as buffer to kind of manage your inventory out of stock. But look, I think when you listen to Gene Sirocco, his statement was that robust container volumes that we've seen earlier in the year, he believes they're going to continue all the way through the end of the year, which tells us a lot about the sort of the bullishness of retailers.
Yeah, and I'm sure they're going to dig into the details a lot more tomorrow with the Zachs on the LMI on the back half. But
we have Zach Rogers, who is one of the authors of the Logistics Manager Index that comes on Freightonomics with Zach Strickland. He'll be here tomorrow to talk about what they read into what does this report say? What does it mean for supply chains? What does it mean for freight markets?
Yeah, but I would be curious to see if we placed July over July, right? And looked
You mean
at
a
it
year-over-year
seasonally.
basis?
Yes.
Yeah, just in terms of sentiment. But
That
remember
there's
last year.
probably always some contraction, right, in July compared to.
I think it's important to remember last year we had all of the noise around Liberation Day tariffs. We were still not out of the woods. There was the fact that the China tariffs had been significantly increased, and then sort of I think at that point last July, we're at a 10% tariff on Chinese goods because I think Trump paused them. There was the threat of them going back on August 1st if we didn't get negotiation. That noise is gone this year. We've had some noise around tariffs, but not like we had last year. Plus, you've got this resurgence in the industrial economy that wasn't playing out last year. Really didn't kick off to November. We've heard that from the railroads. We've heard it from just everybody that's in that industrial sector who has exposure to it has talked about the fact that this year has been strong. And you have the ISM data that also reaffirms that.
Well, I think also putting this in perspective, right? We saw the LMI go down 2 points. But if you put this into perspective, the all-time average is 61.7, and we're still at 68.9, right?
No, that is the composite. That is
Yes.
the composite.
The
It is
overall.
interesting because transportation prices, according to the LMI, are at least the momentum is cooling. Aggregate logistics cost is cooling. So where the LMI is lowering just means some of the pressure on shippers, the continued momentum is cooling. Plus oil. And if we go back a couple of months ago, we were in the peak of oil prices at $115 a barrel. There was some narrative out there that oil could go all the way to $200 a barrel, the moon, it would crater the economy. Didn't happen. We've seems like every weekend we go through this period where this threat of, we start on Friday, we're gonna have more attacks on the Iranian regime, and then by Sunday it's like, nope, pause. I think the president and the administration is very sensitive to how financial markets react to it, which is why there's a lot of posturing over the weekend and then sort of cooling off of relations. We're always going to get a deal, it feels like, every Sunday.
Yeah,
Very
and
predictable at this point.
And I think that this is, again, a normal July. We still are significantly elevated above where we have been,
Absolutely.
even on the places where it's contracted. And I think the reason that this is going to remain is capacity is not going to continue entering the market. We've talked
Capacity
about
not.
it.
And speaking of capacity, there is Department of Transportation has this thing called Operation Highway Shield. What is this, Julie?
Okay, so it's a federal, really, trucking crackdown where the Department of Homeland Security is partnering with the FMCSA and the DOT to do some additional, really, crackdowns on the interstate. So it started in Florida, and then they just had kind of a 3-day blitz at the end of July, primarily through the Midwest, in a coordinated effort. And not that it was a ton of capacity that was taken out. They said more than 750 unsafe trucks or drivers were pulled from the road. 51 people were detained on immigration violations. They found 36 English language proficiency violations, saying that they were really
Was
focusing
that
on.
Duffy? By the way, no, that was Derek Barnes in his outfit. Did you see that?
I wasn't
he was
watching
fully
the
uniform.
B-roll.
There he is. The chief cop on
that's pretty cool.
on the roads. And look, this is I think like the DOT blitz. It's just another. Are they trying to do these periodic blitzes?
Yes, and I think that the interesting part is that they're working together to do it, right? They're working with the states. They're working across the different federal agencies to do this. So I think what it shows is there's going to be continued regulation. It's not going anywhere. There's going to be a continued push for improved safety on our highways, which is going to create more barriers to entry and is going to create continued capacity leaving the market. It's also going to create emotion around capacity leaving the market, which is, in my opinion, going to continue to push spot rates.
Yeah, for sure. Well, the production team is excited to go to commercial break. We'll be right back with our guest in studio. Jay Edlin is going to tell us all about Wove and what they're doing around tariffs. Stay with us.
In freight, again, your customer experience is everything. Every quote, order, and status update is a chance to win or lose a customer, but that will still, again, run on manual disconnected systems. Pallet is the leading enterprise AI built for the supply chain, automating costly operations from code to cash across brokerages, carriers, forwarders, shippers, and warehouses. Mallory Alexander serves 3 times more customers per operator, deliver an exceptional customer experience at scale. Visit them right now at pallet.com.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. These people operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the FreightWaves Playbook. Become part of the 1%. Sign up for FreightWaves Playbook today.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. In studio, we have Jay Edlin. He is the co-founder and CEO of Wove. Jay, welcome to FreightWaves Today.
Thank you. It's so good to be here. It's good to be back in Chattanooga.
Well, last time you were here was in 2022 at F3. I think that was our first year hosting F3.
Yeah, thank you for the free tickets, by the way.
Yeah, it was don't tell anybody that. You're not supposed to say that.
That was 4 years. That was 4 years ago. That was 4
Nobody
years
gets
ago.
free tickets. But let's talk a little bit about what Wove is. You've been doing this for a couple of years, focused on the international trade market. Tell us a little bit about Wove.
Yeah, so I would describe Wove as an agentic orchestration platform for global trade. And I know that's very vague and high level. And the reason for that is because we have the pleasure of serving 2 distinct customer segments. We primarily serve the LSPs, so freight forwarders and customs brokers, mostly on the international side. And then we've also quite recently started to work with shippers for our tariff intelligence product. And yeah, it's all powered by this really powerful AI-powered ingestion engine that we've been building for the last couple of years.
Now, you are not a forwarder, so you're not actually in the market. You sell the data to forwarders. What is it that What is the value proposition to your customer base?
Yeah, we are not a forwarder. We are not a customs broker. We are purely a technology company. And I would say that our customers come to us because the work that we automate, they are largely relying on people, either in-house or outsourced right now. And so we have a unique value prop around cost savings and also time savings, which in this business also means revenue generating. Because, for example, if you're using us to automate quote creation, for example, one-off quote creation into CargoWise is a big thing that we do for forwarders. That's work that generally can take a long time, especially if you are having to request additional information from your customer or request a carrier rate. And we can do that completely autonomously, which allows you to actually quote much faster. And in this business, if you quote faster, you're probably going to win the business.
So tell us, like, very specifically what your tariff engine does, what someone would use it for, a concrete use case.
Yeah, so earlier this year, we launched our free tariff calculator, which is available at tariffs.wove.com for free. And so what we did was we purposed our ingestion engine that we were using to ingest commercial invoices, packing lists, all the crazy unstructured data that freight forwarders and customs brokers use on a daily basis. And we decided to repurpose that for the US harmonized tariff schedule, which, if you've ever looked at it, is completely massive. For example, the Federal Register notice from last week for the new Section 301 tariffs, which came out about 12 hours before they went into effect, was 431 pages long. And that takes many, many hours for even a licensed customs broker to read through and start to interpret. And with the technology that we have under the hood of our tariff engine, we were able to understand and ingest the 431-page notice in about an hour. And we were the first ones in the world to actually have it ready to go and have customs brokers and importers start to know their new landed costs.
So what made you decide to build this free tariff tracker, in addition to what you were already doing? What made you have that pivot and add this new offering?
Yeah, so we're a small team. We're largely bootstrapped, and so we have to be very creative in terms of our go-to-market. And this was late last year around the holiday season, didn't have too much going on. And one of our competitors, who also had a free tariff calculator available, they removed access to a lot of their users because these guys themselves were a customs broker, and again, we are not. And so we just decided to spend the weekend building out kind of a MVP first iteration of our tariff calculator. And we had no idea what was going to happen, but within a few months, we had thousands of people using it every single week, and that's only grown from there. And now that's also now evolved into a really nice API business and a sort of premium tariff calculator business as well that we're seeing users sign up every day, and that's with basically zero CAC. And we're also seeing some really interesting use cases around historical tariff data as well, because what's cool about ours is that because we've now ingested, I think, over 45 different HTS changes since last year, we act as a tariff time machine. So companies come to us and they can actually use our API to do historical audits for their own either internal purposes, which is a very powerful use case and something that we didn't even know about a few months ago.
So just true, startup example. We decided, and we just built it over the weekend. We got together.
You can hustle.
Love that.
You just had
love
grit
it.
and grind and hustle. In fact, interesting enough, Keep Trucking, which is now one of the most successful ELD companies out there, now called Motive, actually started by doing that when the ELD mandate was a couple years out. They ended up doing electronic logs, giving it away for free. And that helped them attract hundreds of thousands of trucks into their ELD device. So there's a great case for that. Now, you're referring to Flexport had a calculator when you say competitor, but you don't view them as a competitor, right?
Yeah, Flexport is not a competitor to us in the sense of we are not a forwarder or a customs broker. I was really just referring to that they have a competing tariff calculator, but I believe, at least per my knowledge, they are not trying to monetize their tariff calculator at all. But
it's for their customer base.
Yeah, they do make it so that you have to be a Flexport customer to actually use it on a regular basis.
And your calculator is available for really anyone out there, including LSPs that may compete against Flexport. Should they be, in your view, offering, if I was a forwarder, should I send your calculator to my customers? What's the downside of that?
Yeah, if you're a forwarder, we are more than happy to either have your customers use our free tariff calculator. We do that for a lot of forwarders and customs brokers. We see them referring their customers to us. We've also seen a lot of interest, though, in white labeling the tariff data, such that if you're a customs broker and you want to have your own white labeled version of a tariff calculator on your website, then you can use our data for that. That's part of the business that we've built.
So Steam, that is a customs brokerage in Chattanooga, could certainly have the Steam calculator if they decided to do.
Yeah, and we'd be
And
happy
their
to power it.
customers would, I mean, ultimately their customers may not care what the data comes from. They just want to know, is it trustworthy? Can I trust it?
Yeah, and I believe our data is incredibly trustworthy, but we have Fortune 500 companies using it. We even have academic researchers using it. So we've been elated and surprised with all the excitement around what we've been building on the tariff side.
So you give away this for free, this calculator, but how do you make money? Like there's obviously a commercial angle here.
So the tariff calculator has been primarily a lead gen tool for us. Again, it's being used by thousands of users a week, and that's naturally led to inbound for our other products as well. Most of what we sell is our core automation platform for whether it's automating shipments, whether automating customs entry writing, automating quotes, really any of the core work that a freight forwarder or customs broker is doing on a day-to-day basis. But again, as I mentioned, we also do license the data via our API, and we've also built out what we describe as a product catalog module as well, where if you're an importer and you have thousands of SKUs that you want to see in real time the tariff exposure, and we allow you to bulk upload those spreadsheets with your SKU data, and basically have a calculator with all of your SKUs where you can do simulations and historical analysis.
I mean, the whole HDS, the whole codes, trying to get into that, navigate it, interpret what it means is just a disaster. I mean, government at its worst is all of this stuff. And look, a lot of this stuff didn't change as dynamically, as fast. It's constantly being disrupted, and maybe not as important. But when you have the administration doing executive orders and constantly sort of tariffs are on the move, it is hard to interpret what all these mean.
Yeah, no, absolutely. And we also have the benefit of working very closely with a lot of licensed customs brokers who are being very kind, and if they do find something that they think is interpreted incorrectly, they will communicate that to us, and that's that feedback loop where we can turn around those corrections in a matter of minutes is worked really, really well for us.
Yeah, I would imagine just the time in interpreting it and getting a solid answer immediately of the estimate of what it's going to be would be incredibly helpful.
Yeah, especially because I don't know how much time you guys have spent actually looking through the HTS, but through our 45 revisions or so over the last year, I think we have something like 3.2 million different rules. And that's all the different Chapter 99 exclusions, inclusions, effective dates, things like that. It's
I mean, the
really
crazy part is that when you get these executive orders, first of all, you get the classic Trump tweet that may or may not ever get into an executive order. Then you get the executive order. Then it's got to get into the Federal Registry, and oftentimes they sort of the different rules pivot, and it's I get asked a lot about Trump tweeted this, and I'm like, we don't know if that's actually going to make it. Like, he tweets a lot of stuff.
Yeah. Newsflash to everybody watching: just because Trump says something on live TV or tweets about it, it does not necessarily end up as law or as a Federal Register notice. So we've seen a lot of...
Even the executive orders is just an order to basically update the registry, but oftentimes those get changed by the time. You don't really know what it is until the final rule comes in place.
So we've automated the whole process of once a Federal Register notice is released, we get a Slack notification, and then we have an AI agent basically go in and understand the changes and then make the changes accordingly.
Very cool. So I want to talk a little bit about your core business as well. Can you give us some examples of the problems that you are solving for some of your core customers and the value you're bringing there?
Yeah, absolutely. So a great example of one is a freight forwarder that we're working with right now that we're onboarding for both shipment registration and customs entry registration. This is mostly into a system called CargoWise, which I'm sure a lot of your viewers are familiar with. But a great use case is when a packing list or a commercial invoice comes in and there's, let's say, 2,000 lines, which is not unheard of, and it's something that our customers are dealing with on a day-to-day basis. Before they implemented Wove, they were actually doing this entirely manually. So looking through every single commercial invoice line and entering that into the TMS. and we can do that in about 30 seconds. So that's a relative
Massive process improvement.
Yeah, I would say, and yeah.
So Jay, what about, this conversation's been going around about Claude or AI disrupting the whole customs brokers? Like, you don't need custom brokers. I've heard this from venture capitalists. But like, if so-and-so used AI, you may not, this thing is going to be blowing up. What are your thoughts on that?
Yeah, I don't believe that just adopting Claude Code or Codex replaces a customs broker. Again, we're not customs brokers ourselves, but from working with the people on the ground that do this important work day in and day out, they do really important work. And we believe as a business that that work should not be entering line items from a packing list or an invoice into a TMS. It should be helping your customers interpret the latest Chapter 99 rules or the latest tariff update. And so that's really, I think, the important work. And I know everybody talks about how this is a relationships business, and that's exactly kind of what we.
Well, I think nobody wants to deal with it. Like the whole idea. I mean, I understand that
It's complicated. And
it is complicated.
tedious.
Keeping track of it, but also the idea that businesses that are not that a guy with $100 million business is going to somehow use Claude to deal with is just nonsense. Real estate agents, you've had the ability to list your home for 20, for 50 years, whatever the number is, on the web. People aren't doing that. Like they are somewhat, but it's very marginal. You still pay real estate agents because you don't want to deal with the problems.
Yeah, there's something to be said about comparative advantage and outsourcing laborious work to the experts.
Especially really boring, tedious, illegal nonsense.
That has to be right.
It has to be right, but it is all just jumbly juke to somebody who doesn't deal with this.
Yeah, we are seeing, I think, some importers come to us and ask if they do a lot of the work themselves, whether it's auditing using our tariff time machine and our real-time tariff data, if that means that perhaps they can then pay less to their customs brokers, which is because they would, again, be doing a lot of the work themselves.
Yeah.
So that's an interesting one.
I understand what if scale. If I ran $1 billion importer, perhaps I could have the scale and take on some of that burden. But if I'm a mid-sized company, why would I even bother?
Yeah.
It just seems like a lot of work. Let's talk about USMCA. We are, super bullish on the commodity flow in the United States. We're going to hear the AAR reports Wednesday. So it's my favorite day of the week, which is our AAR weekly data. Commodities are doing well, but USMCA, Canada isn't doing as well as the United States. What is your thoughts on USMCA?
Yeah, I mean, we look at USMCA through the lens of just our tariff data. And I mean, I'm not going to go out and say I'm a policy expert or I know what's going to happen tomorrow. I just know that when there inevitably will be changes to the USMCA, we will be able to update our tracker and our tariff data in real time.
Well, the administration says they're not renewing it. So any thoughts on Canada-US trade? Anything specific?
I would just say that, I mean, this administration did negotiate the USMCA during their first
Version
administration.
1, it was the best trade
Of course, that was
policy ever.
That was
according
7
to-
or 8 years ago at this point, maybe even longer. But Canada and Mexico are, I think, two of our biggest trade partners, and that's not going to change anytime soon, if ever. And as
Feels like
just from a
Mexico-
personal perspective, I believe in a rising tide lifts all boats, and I think that we are better off as a country when both Canada and Mexico are stronger, and we've had the benefit of working with lots of companies in both parts of and in both countries, and we want to see them succeed because that means that we succeed as well.
Well,
Right.
Mexico has certainly been more proactive. The administration, the president down there she's been very willing to negotiate. You could argue that Mexico is I think more. There's I think a sense in Canada that they've always been offended by America's global presence and sort of being the little brother. Like there's this sort of like, whereas Mexico kind of accepts their position, and I think much more so than Canada does. And I think that's one of the reasons that Canada hasn't been as proactive, perhaps because politically that's a challenge, whereas I think Mexico kind of understands their role.
Yeah, I think that's right.
So we'll see. It's going to be interesting to watch. What is so you haven't raised venture capital, a large amount of venture capital. What are you going to hope to do with the business?
Yeah, so we have raised to date less than $500,000, which
Which
I
is
think
like
is
nothing.
which is
Yeah,
very,
for
very
friends and
little.
family around, so.
Exactly. And I did hear your conversation, I think, right before this about the SaaS apocalypse and companies that may have raised at the peak of the cycle. And I think what we want to do with the business is just continue to build a best-in-class product and serve this industry that we've come to really appreciate and love. And whether that means turning this into a quote-unquote lifestyle business where we can do this for the next 20 years, or we ultimately find an acquirer or some sort of exit path, I think those conversations will come in time. But for now, we're really just having fun finally building the business. It did take us a couple of years, I think, to go from 0 to 1, as I think is the case with many companies. But recently, over the past year or so, I mean, we've 7x'd ARR. It's only...
What is your ARR now?
Yeah, I can't share our
You'll share the
real
growth
financials.
rate, but you're not going to show the number.
Yeah.
It's a very, very typical founder. Look, I get asked the same questions. I can do that. Well, look, a lifestyle business is great if you're having fun.
Yeah.
You having fun?
I would say I have a lot of gray hairs over the last couple of years. I would say I'm finally having fun because we're finally focused on really building the business and not just thinking about survival.
Yeah.
Well, that's always relief when you wake up and don't have to worry about what is in my inbox that's going to blow up today that I got to deal with. Right?
Yeah, exactly.
Or my text messages are blowing up. I understand that painfully well. Really appreciate Jay coming in and telling us all about Wove. And where can folks find the calculator again?
Yeah, so they can find the calculator just at tariffs.wove.com, and they can learn more about us at wove.com.
And check that out. You've got by the way, you're on X. You're a great follow on X. So
I'm more of a lurker these days. You're a great follow.
Well, we the X people stay together. So it's a club. We will be right back with our favorite day of the week and our favorite segment. We have Bill Stevens is going to tell us all about the railroads with the weekly AAR report. Stay with us.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts. 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. It is Wednesday. It is the best day of the week. Not only are we halfway through the week, we are at our weekly segment sponsored by TrinityRail, which it is the AAR weekly report. And our editor from Trains Magazine, which everyone should subscribe to, amazing publication, Bill Stevens, with us. How you doing, Bill?
I am well. How are you, Craig and Julie?
How are the railroads? Are they putting up good numbers? Is the rally continuing?
They are if you set aside coal and chemicals. So we will start.
It's in a perpetual decline. It's not coming back.
It is, but it had a pretty big. It is, but it had a pretty big impact on the carload numbers today. So we'll go over those, including coal and not including coal. When you start at the top of the list and look at North American rail traffic, carload traffic was up 0.5%, so basically flat. Intermodal was up 4.3%, which gives us a total increase of 2.5% North American rail traffic for the week. That is a bit of a slowdown compared to the prior 4 weeks, where it was up a little over 4%. And in the U.S., 7 of the 10 commodity groups tracked by the AAR posted gains. But still, carload was down 0.4%. That's compared to the 4-week trend of up just a little bit under 1%. Intermodal was up 4.8%. That's also a little bit of a slowdown from the 6.4% increase over the prior 4 weeks. So that gives us a total increase for week 30 U.S. rail traffic of 2.5%. And that is, again, a slowdown from the 3.8% over the prior 4-week period. However, if you subtract coal from that total, and coal is the largest carload segment still, carloads were up 2.1%, and that compares to a 3.1% 4-week trend in the prior 4 weeks, and up 4% year to date. We drilled down a little bit further. Chemicals, which is often the second largest traffic segment, that was down 2.2%. Year to date, it's up 2.4%, so a little bit of a blip there. When we look at grain, the other top 3 traffic commodity, that was up 4%, in line with its trend for the past 4 weeks. And then, steelmaking apparently is still on a tear, according to the AAR data. Metallic ores were up 16% this week. Well, scrap iron and steel was up 20%. And both of those are higher than their prior 4-week trend. So that,
real solid, Bill. I mean, the industrial economy continues to be robust. Take coal out of it, 4.2%. That's real strong. I mean, it's interesting. I point out that it's 4% growth on X, and immediately I got the naysayers that are like, that's not a lot. But I'm like, this is like hardcore GDP growth right here.
Yeah, the carload numbers really closely track with industrial production, and industrial production doesn't really. It's not a hockey stick,
grow
right?
4% a year. That's a real strong number. I mean,
yeah.
I mean, we're also getting other data points. Julie reported on the LMI today, the ISM yesterday, which are both affirming that the industrial economy is doing quite robust. ISM was at the highest level since 2022. LMI, a little bit of, I call softening, but not, still very robust. When you're at an extreme high, it cools a little bit. But I think it's telling us that the economy is doing quite well right now. The freight economy.
That's what the data suggests, that the underlying economy, industrial economy, is strong based on this broad commodity growth, 7 out of 10 commodities that the AAR tracks.
So,
yeah,
Bill,
and I like to look at the year-to-date numbers too, compared to 2025, rather than just week over week. And when you look at the U.S. rail traffic, carloads up 2.7%, total units up 3.8%, total traffic up 3.3%, and literally everything is up year-to-date except coal on the U.S. Railroads.
Chemicals have cooled a bit.
Mexico way up.
Chemicals though, like they came on real strong in the first quarter. They have cooled a bit. Bill, any read into that? Is that just because of commodity inflation due to energy and oil? I mean, oil is such a big input into chemicals. Is there anything to read into that, or is this just a little bit of softening?
It could be a little bit of softening. It could be a little bit of noise in the numbers.
Last year, you had the Liberation Day tariff, kind of, I don't know what you call that,
Yes.
but noise that's in it. So, Bill, earlier what day is this? Was it last week? It was last week, wasn't it? The days are blurred for me, but we had the BNSF Chief Strategy Officer. Was that last week? No, it was this week.
No, that was this week.
Yeah.
It was Monday.
Yeah.
You watched the show. You know what
Monday.
I'm talking about, Bill. Thank you. Probably
Yes.
arranged the interview. We had the Chief Strategy Officer of BNSF on. He obviously is not supportive of the merger. Really said it's bad for consumers. I don't know if you got a chance. It sounds like you did watch that interview. Any thoughts there?
Yeah, I mean, that he really boils down the anti-merger argument. And it is, of course, night and day difference from what UP and NS say their merger will bring. And we are going to see this debate play out over the next 12 months as the Surface Transportation Board reviews the deal. Important note there, though, is that this is being held in abeyance until the STB fully reviews the 400 plus pages of supplemental information that UP and NS filed a week ago Monday. And we don't know if or when that procedural schedule will be set and when it will resume. And once it does, there will be a flurry of inbound comments to the board, pro and con, about the merger.
Did we learn anything in that interview? Because I just felt like he was talking his own book. And I'm not, knocking BNSF. Their position's pretty assertive in terms of how they believe and feel about it. But it feels like he was talking his book about, positions. I mean, in fairness, so was UP and NS. But it didn't feel like I learned a lot in that interview.
Well, that was consistent. And, he did speak to that supplemental information that UP and NS filed. BNSF has been particularly critical of the committed gateway protections that UP and NS are offering. UP and NS said that, hey, we just doubled it, and the number of shipments that are eligible, and we brought in bulk trains like of grain into the program that weren't there before. BNSF still looks at it and says, well, that's such a small number, or it has an expiration date on it. Why wouldn't it be full time? And so that's one of their big concerns is what happens to the interchanges that BNSF currently has with Norfolk Southern or at other gateways. How do those hold up after a merger?
We had Gene Soroka on yesterday, Port of LA director. He was very supportive. I think that makes sense. I mean, that arguably benefits the West Coast ports, because if you do get faster intermodal service across from the West Coast to the United States through the U.S., should benefit shippers to leave their containers through the Port of LA.
That's right. There's this kind of battle between the East Coast and West Coast ports in the center section of the country, in the Ohio Valley, in the Mississippi Valley, even places like Chicago. If you can reach it equally well from the west or from the east, this would give the West Coast ports perhaps a leg up compared to their East Coast competitors if one railroad can handle the move from the West Coast all the way through the watershed to places like Detroit, Pittsburgh, Buffalo, Cincinnati, you name it, that is currently on the eastern side of the east-west divide between the U.S. Class I railroads.
Bill, have we seen a shift in sentiment in terms of, has there been any party that perhaps has shifted its support or has contracted its support of the merger, or is it pretty much the same parties that you would expect to be supportive are supportive and the parties that don't? Has there been a shift in the last couple of months? Any public narrative that shifted the way people are thinking about this?
No, really the only shift has been Canadian National reaching a deal with Union Pacific for access to Mexico. Union Pacific in exchange gets better access through Chicago over Canadian National. And then Canadian National also, if the merger were approved, would gain access to St. Louis and Kansas City and serving customers between those points across Missouri, where UP would pick up some Norfolk Southern routes and therefore would have some duplicate parallel routes. And CN says, hey, this eases our concerns that we had about this merger's competitive impact on the CN network. And so we will now drop our opposition to this merger. Remains to be seen whether UP and NS can cut similar deals with other railroads that remain opposed to the merger. And we'll just have to wait and see.
Does the administration or STB really care what the Canadians think? And I don't mean any disrespect to our Canadian friends, but like this administration is all make America great, very America first. Is there really an audience for Canadian opinion in these transactions?
There definitely is, because Canadian nationals lines come into the U.S. at the Michigan border, and then up in Minnesota, they come down like a Y, they join in Chicago, and then they go all the way south to Memphis and New Orleans. And so that's an important route. And the STB takes a look at competition within the U.S. and within the U.S. rail network. And that is an important section of it. So yes,
I think the Canadians have the prettiest trains. The CPKC, the big red, I actually love. I think it's the most gorgeous train. And some of the photography of those trains in Vancouver and British Columbia, just something about the scenery of that. I know you're a big train livery guy, Bill, and you love beautiful photography of trains. What is your favorite livery?
Oh boy. See, now that's like asking me to name my favorite kid. I can't do it. And they are all interesting and in some cases historic. You look at CN, they have the CN Noodle, it's called, that was developed in the 60s. That's kind of this iconic logo. Union Pacific's logo has remained pretty much unchanged since 1862. So if you like history, there's that. Canadian Pacific brought in its history. It really was the railroad that created Canada. And so, they've got a beaver, the Canadian symbol, as part of their logo. So they all have their pluses and their minuses. But what I'm really excited about is this America 250 locomotive celebration that we'll be having later this month at the North Carolina Transportation Museum in Spencer, North Carolina, where we'll have about 36 America 250 locomotives painted up in red, white, and blue and assorted other colors in some cases. And we'll also have some bicentennial locomotives there that were painted up for the 200th back in 1976.
Now, is there going to be any surprises, any liveries we haven't seen? Have these been kept in secret, or is it they're all coming together to rally, but we've seen them out before? I know that a lot of the railroads have come out with some of the more patriotic livery, not unusual. We've seen the different railroads throughout history sort of honor presidents and honor historical factors, but is there anything unusual or new that you have not seen that you're looking forward to?
I haven't seen any of them in person, so I'm looking forward to seeing all of them. As a kid, I remember seeing bicentennial units come through town, and one of those, the Norfolk and Western 1776, will be there at the event. So looking forward to seeing that for the first time in 50 years.
Amazing. Well, it's so cool. Are you a big library fan? You don't really like libraries, airplane libraries, and train libraries. After the transaction with Kamp, where we got trains, I've become a huge. You know how much I love the railroads.
Love it.
I talk about it all the time.
I feel that same sense of like history and nostalgia
around it, but I just am not
as close to it as you are.
I was not a big railroad geek, but I am now. I love the railroads, and we talk about it all the time, how much we love I love the railroads here.
So while we're on the topic, though, I've been wondering, Bill, behind your shoulders, obviously you've got two gorgeous pieces of art. One of them looks more like a passenger train in Europe, but what is the other one?
Well, it's not a passenger train.
Okay, I don't know what it is.
What is it?
Yeah, they are both passenger trains. The one right here is. There we go.
That one, yeah, that looks like.
What is that one, Bill?
That one is the Canadian Pacific, the Canadian.
Boom.
On its original route. That equipment dates to the mid-1950s. The Dome observation car, still in use today on Via Rail Canada.
I didn't say it wasn't passenger. I just yeah.
And that I highly recommend riding Via Rail's Canadian. It now runs on Canadian National, but fantastic service, food, and awesome scenery.
I think that
the
has
other
to be probably the most gorgeous views. Like, that would be amazing.
We should do a remote.
Okay.
We need to get a
lot of motion
Starlink.
sickness medicine.
Maybe we should, Bill, you need to call your friends at CP to see if we can do a remote FreightWaves Today. We'll put a Starlink antenna on the top, and we will broadcast live. I think it'll be pretty epic.
So fun.
That would be cool from the dome car. Yeah. The other one's in the Hudson Valley of New York. That is back in late 1980s or
now I'm trying to look.
Yeah,
it's hard to see on screen. Is that a NS, CSX? What is that?
that's Amtrak.
Amtrak. Okay, that's cool.
Very
Yep.
All right, we're gonna go on this passenger route.
That would be awesome.
There's also the Star Train that's in Santa Fe, New Mexico. It feels like an astronomy crossover. Bill, have you been on this one where you can go out in the middle of the stars?
I have not, and the Alaska Railroad does that as well. And I think
I did
they
that, by
run
the way.
some.
I did. We went through Denali National Park. It was I think it actually is the Polar. It's either called the Polar Express or nicknamed the Polar Express. But we went right through Denali National Park, 8 hours from Anchorage to Fairbanks. I did it 25 years ago.
I bet it was cool.
It was really cool. But the problem was, we did it over the winter. It gets so dark so early that it was really incredible. But the Northern Lights on that particular trip were not out. Now later in that week, we were able to see the Northern Lights from Fairbanks, but wasn't as cool as I hoped it would be. Probably better to go through during the summer when it's light all the time.
Unless you want to see the Aurora Borealis, which is what they have one of those trains too.
Well, I got to see them when we were up in Fairbanks. So we got the Aurora. We went on top of a mountain. Aurora came out. Weirdly enough, we've had the Aurora in Chattanooga, Tennessee the last couple of years. So we've had nice
it's been some strong activity.
Not supposed to happen, or historically hasn't happened. Well, Bill, every week we love having you on. I'm looking forward to this CPKC across Canada. And he's right. The Canadian railroads, that east-west traffic, built all of those major provinces. Because if you look at the Canadian populations, it's all on the U.S. border.
Right.
But really what CP did was built the whole southern border.
Yeah.
CP.
Yeah, it makes so much sense, right? Like that it truly helped develop those areas based on
And by the way, a little bit of history, a little bit of geography. You can't build in most parts of Canada. It's a huge country, but because of the Canadian Shield, you can't build. And so that's the reason that it's along the population.
Yeah, I'm gonna have to do some research on Canada. I've been reading a lot of, like, when I'm not working, I read like fiction, chick lit fiction. Yeah. And they've all been set in Canada lately, and I have been like, dying to like see
something happen in Canada.
No, it talks about how gorgeous the scenery is, and how beautiful the landscape is, and it's making me want to go ride this train now. And
we got to do it. My son, by the way, my 7-year-old son, he watches these geography YouTube shows.
Yeah,
and he's become this encyclopedia of geographical knowledge. That's how I get some of my information.
Me too.
We'll be right back. We're going to talk intermodal. The trains are continuing to run here. We have Jeff Anderman back to FreightWaves Today. He is the CEO of STG Logistics. We're going to talk about the state of intermodal. Stay with us.
In today's supply chain, every mile and every minute matters. Shippers, lessors, and railroads count on performance they can trust. That's where Trinity Rail delivers. With integrated railcar solutions including manufacturing, maintenance, parts, fleet management, and leasing, helping you reduce downtime, optimize your fleet, and stay ahead of demand. Because efficiency isn't a goal, it's a competitive edge. Trinity Rail, built to deliver.
The world doesn't wait, so neither do they. Wheels on the interstate, boots on the site, hands on the shipment. We build for the world out here, and we build it with the people who live it. Ideas from the field, made real by world-class R&D to keep the operation sharp, the front lines safe, and the world moving. From one cab to a global network, billions of miles, trillions of data points, every one making your operation better. And we never build it alone. Samsara, built with operators.
Once a year, the entire freight industry stops what it's doing and comes to one place, Chattanooga, Tennessee. This is F3, the Future of Freight Festival. It isn't just a conference. It's the largest festival in freight, built to pull you all the way in. The energy, the ideas, the atmosphere, and the people who move this industry forward. Over 50 speakers, 4 events across 3 days, founders, executives, innovators, and disruptors, all under one roof, all asking the same question: what comes next? On the main stage, the sharpest minds in freight take on the biggest questions in the business, the trends, the technology, and the forces shaping what's ahead. Then the clock starts, 7 minutes, no exceptions. The cutting edge of freight tech goes head to head, live, battling for best in show. When the time's up, the lights go out. And in between, the conversations that don't happen anywhere else. The connections that change the trajectory of your business. The relationships you'll carry long after you leave. Because when the sessions end, the festival begins. Live entertainment, unforgettable experiences, a celebration of the world of freight, and an energy you won't find at any other event in the industry. The leaders you need, the access you won't get anywhere else. This is where knowledge is shared, where deals get done, where the future of freight gets decided. F3, Future of Freight Festival, October 27th and 28th. The Signal, Chattanooga, Tennessee. We'll see you there. Register now at live.freightwaves.com.
Welcome back to FreightWaves Today. The trains are running, and they're running on time. And Jeff Anderman, one of the largest customers of the trains, is going to tell us all about it. Welcome to FreightWaves Today, Jeff. Intermodal having a good year. What are you seeing?
Hey, thanks for having me back. Yeah, it's busy, right? So the demand for intermodal volume or intermodal service is growing, which we're obviously excited about, and really looking forward to kind of seeing how that plays out for the rest of the year.
So you guys have restructured you know a company that's been through I call it a period of history where Chapter 11, you're out of that process. You now have new ownership. Fortress, Fidelity, and Invesco are new owners. By the way, Invesco is an investor in FreightWaves, so a little bit of hometown Atlanta pride there. Tell us a little bit about the new ownership group.
Yeah, look, the ownership group is very supportive. I think very excited about the future of the business, and so we're sort of excited to have them involved. Expect that they're going to support us as we continue to grow our business, continue to sort of ride the wave of enhanced interest in intermodal service, and expect a lot of good things sort of coming out of this process that we just wrapped up earlier in July.
What is the state of intermodal right now? We're seeing the data. J.B. Hunt, being a public company, gives us an enormous preview into the state of freight. Intermodal blew it out of the water for J.B. Hunt. What are you guys experiencing right now?
Yeah, I mean, demand is strong, and I think it's like J.B. Hunt and others have said. I think sort of our ability to kind of meet that demand was almost hindered a little bit, I would say, in the second quarter. As a result of some tightness in dray capacity in the marketplace, whether that's with our own drivers or third parties. We could have done more in the second quarter, and we actually had a good, strong second quarter from a volume perspective, but we could have done even more. There was that much sort of demand for the service out there.
Jeff, do you guys view J.B. Hunt as a competitor, or are you after the same, is really the truck the competitor here, and you guys have the same mission?
Yeah, no, look, I think broadly speaking, we view the trucks as our biggest competition, right? I mean, trucking, over-the-road trucking is obviously the most clear and largest substitute for intermodal service. Obviously, folks like J.B. Hunt, Hub Group, Schneider, Knight-Swift, they're all sort of active in the intermodal space. J.B. Hunt obviously being the largest, but those other companies that I described obviously being formidable sort of providers and carriers as well. So we do view them as competition, but obviously have tremendous respect for them. I think all of us are very much interested, though, in taking freight off the road and using intermodal capacity and leveraging our partnerships with the railroads to provide a efficient reliable and obviously energy efficient sort of solution as well, or substitute for over-the-road trucking.
Jeff, you mentioned a tightness in dray capacity in Q2, sort of limiting growth ability and ability to accept freight. What are you seeing so far this summer as we are, I guess, well, into August, so a month, almost a half.
I think we're still we're still seeing some of that tightness, right? So not unlike what's happened in the over-the-road market, many of the things that have happened there to kind of drive capacity out of that market, have certainly impacted the drayage market as well. And remember, for intermodal, you have a truck move, a dray on each end of a rail line haul. And that obviously requires, a driver with equipment to be able to pull that container, to or from the railhead. And so we're still seeing some of that tightness. I think the cost of dray capacity is going up, just like it is in the sort of over-the-road trucking market. And so we're actively sort of managing that in real time here to make sure that we're able to provide the capacity that our customers expect.
We've heard that dray capacity due to the compliance crackdown is a big issue. Is just driver availability. Are you hearing the same thing?
Yeah, absolutely. I mean, that's what we're feeling in real time. I would say, we could very easily put, a significant amount of incremental drivers to work right now, given the demand we're seeing in the marketplace.
I want to go back a little bit to the restructuring and being in a more positive financial state. So What do you guys focus on next? Where do you find the next efficiency? What's the next big thing?
Yeah, so we're a little bit unique relative to some of those other sort of providers I referenced earlier, in that we have the ability to combine an asset-based intermodal offering, 15,000 containers, internal dray coverage on each end of the rail, with, I would say, pretty sophisticated expertise and capabilities around logistics. So actually transloading, loading containers, unloading containers, consolidating and deconsolidating freight inside, 4 walls of a warehouse. And those are capabilities that honestly allow us to do more for our customers and provide, sort of better outcomes and efficiency for them. So as an example, we do business with a very large, kind of retailer in multiple locations on the West Coast. We were able to sort of support them in consolidating the number of providers they had in their network around specific distribution centers and facilities that they use, and drive, pretty meaningful costs out of their supply chain, as well as provide, sort of more efficient, reliable service as kind of that sort of one throat to choke provider for them. And we want to do more of that, right? So, talking to our customers about how we save them money, how we provide them a better service, and how we, drive better outcomes in their supply chain, leveraging both our intermodal and our drayage capabilities, but also our logistics capabilities, to make their lives easier, and obviously, sort of make their supply chains more efficient.
Jeff, we've had our Future Rail Symposium last week. We had UP and NF's CEOs in studio, much like yourself. Last time you were here, talking to our team, talking to us, frankly. The two CEOs were talking to Bill Stevens. They're very bullish, obviously, on what the merger means. As a user, as a customer of the railroads, how do you feel about it?
Yeah, look, I understand why they're excited. Obviously, the idea of connecting two railroads so that you can connect the full continent, or the full U.S., I should say, so that you take, kind of handoffs out of the equation, potentially drive more efficiency, some of those things like that. I get the excitement. Ultimately, for us, we have long-term relationships with all of the railroads that are operating in the U.S. today. For us, we want to just be able to provide competitive, kind of cost-efficient and reliable services to our customers. So ultimately, to the extent that the merger allows us to continue to do that, we obviously get it.
Do you think it benefits intermodal more so? I mean, there's been, it seems like the intermodal case is a strong case to make because you should get faster service, competing against truck. There's this sort of ceiling on how much intermodal, frankly, you guys could charge because you also ultimately have a truck that's always there. It puts a ceiling where I don't think you're going to see, at least my perspective, is that you'll see there's just a ceiling on frankly what you could charge intermodal. It feels like the bulk shippers are the ones that have the most concern about this. Any perspectives on how you're thinking about it?
Yeah, I mean, look, we're sort of listening to understand sort of how they plan to sort of bring the networks together again to enable incremental growth. So to the extent that it allows folks like us, other IMCs, sort of other users of intermodal service and the railroad in general, to the extent that it allows those things to happen or enables sort of that advantage. We're certainly open to kind of learning more about that and understanding how it can support growth in our business and kind of help us support our customers.
Jeff, appreciate you pointing that out. I think everyone's afraid to sort of say what they really. We got to get you at dinner one night with some drinks in you to get the real truth of how you feel about it. Everyone's afraid to sort of step out in front of it because, look, these are, that's the challenge. These are major, powerful partners of yours, and if you, as you work with different providers, they have a different opinion. We've heard the case of NS and UP. We've also heard BN be very on FreightWaves Today. Chief of Staff was very out front about how they feel and against this merger. All of this makes sense. I think it's ultimately the bulk shippers are the ones that I think are going to end up having the most to say in terms of opposition. They're the ones that are, if there is a sway against it, it's going to be the bulk shippers that really, I think, tilt it, in my opinion.
Yeah, look, I think that's a fair perspective. I think the thing I'll say is, whether you attribute this to what UP and NS are trying to do or not, I think we've seen excellent rail service over the course of the past 12 months from all of our partners. And so, again, you can attribute that to what is going on in the marketplace. You can attribute that to just the focus that the railroads have put on enhancing service and making sure that they're truly a viable and reliable mode versus truck coming out of sort of the COVID boom times. But ultimately, again, we need that rail service to be there, and it has been.
So Jeff, you've got a new balance sheet, 90% less debt. It's got to feel great. That's not holding you guys back. You've got the ability to go build the business, invest in the business. What are you going to do with it?
Yeah, like I said, we're going to continue to invest in our logistics capabilities aligned with our transportation capabilities, so asset-based intermodal drayage. We're going to continue to invest in our people. We're going to continue to invest in sort of building the growth engine here, and that could be through obviously our go-to-market strategy. That could be through technology, sort of all those good things that help us be a better partner to our customers and a better partner to our key partners, the railroads and anybody else that we're relying on heavily to execute on behalf of our customers.
So Jeff, based on your service offerings, you really have a full port-to-door view of the freight market. We talked a little bit about demand for intermodal being strong and capacity being tight there on the drayage side, but talk to us a little bit about what you're seeing at the ports, what is happening there regarding tariff volatility. How exposed are you guys to that, and what are you seeing as far as what we can expect in the market?
Yeah, I mean, look, I think there continues to be volatility, right? I mean, obviously, what's going on geopolitically, whether that's what's happening in the Middle East and how that's impacting fuel prices, or sort of what's going on with tariff policy, that obviously creates volatility. And then, obviously, we're a heavily sort of imbalanced economy from an import-export perspective, regardless of kind of what the tariff policy has done over the course of the past couple of years. And so, the consumer obviously has a heavy impact on kind of what we see from a demand perspective and in terms of what you see flowing through the ports. So there's still some volatility out there. I would say Q2 and coming into kind of early or late summer here, early Q3, we have seen some strength in terms of activity flowing through the ports. But ultimately, we'll see sort of what the back half of the year brings in terms of kind of how much of that was front-loaded sort of activity ahead of incremental changes in tariffs. How much of that was trying to get ahead of fuel, sort of some of those things that can make things a little bit more sort of unpredictable and kind of get back to that volatility word that you mentioned earlier, and I've said a couple times here.
Yeah. What are your thoughts on that consumer sentiment? We sort of get mixed views from some of our guests. I think we think it's relatively strong, right? And that certainly the industrial economy is strong, and that we've heard from quite a few of our guests that the consumer sentiment is relatively strong. Some people
Geodis,
still feel that way.
The CEO Geodis yesterday pointed out that in certain sectors, apparel is really strong. I think it's because people are slimming down. But in housing, it's kind of weak. So it just depends on a sector by sector specific. What are you guys seeing?
Yeah, it seems to be holding up relatively well from a consumer perspective. I agree with you, Craig, that housing continues to be relatively soft, and obviously that's been historically a big driver of freight demand. So sort of the way we think about it here, and when we talk to customers, is obviously the capacity is tight, particularly from a trucking perspective. And that's with demand that I'd say is just okay, right? So to the extent that there is any meaningful inflection in demand, I expect that to be a pretty significant catalyst for upward pressure on freight rates from carriers to customers or shippers as a result, given how, again, the capacity seems to be relatively tight because of all the regulatory things that have been done and the compliance things that have been done over the course of the past 12 months or so.
Jeff, are you seeing shippers for the first time try intermodal? Are we seeing a modal shift where shippers are now saying, hey, I haven't tried intermodal before, I should try it? Or are we seeing the growth come from existing shippers that already had intermodal operations that are ramping volumes?
Yeah, I'd say it's both. Though we are seeing opportunities for modal conversion, and I think some of my publicly traded competitors have obviously mentioned that that's something that they're seeing as well on a focus. So I think you're starting to see, particularly with truck capacity tightening, tender rejections, and all that you guys cover in detail, and then the rate pressure that's creating. I think you're starting to see some people come around and say, hey, might make sense for us to try intermodal. Maybe in lanes or regions that we had not historically. And to the extent that our rail partners and working with us are continuing to provide good service, I think there's going to be go forward opportunities to continue to execute on those conversion opportunities.
Yeah, I think once they discover it, Julie, we've talked about this, is like once they discover it takes them a couple of months. Stuff isn't immediate. You got to build your infrastructure. You got to redesign your network around it. It takes some time, but once you discover it, and you realize that the service is good, maybe not as good as truck, but it's far cheaper. And when truck capacity is tight, this is a good opportunity.
Yeah, I think when they get through the learning curve, they understand how it works. Yep. They understand, they either have someone taking care of it for them from, door to door and getting it where they need it to, and then they don't have to understand how it works. They just have to be comfortable with the transit time.
That's true.
Or they have to start, understand how the railheads work, and then once they get there, they've learned it, and I would imagine stay.
All right, Jeff, the most important question of the day.
Okay.
If you had to pick a livery of a train, which one would you pick? Who's got the best liveries out there?
Oh, man. That's a tough one. I'm going to have to go with UP. Yeah.
You like UP's best. Is this because you guys do a lot of business at UP and you got to talk the book, or do you really believe it?
No, I believe it. I believe it. Look, there's probably some truth in what you said as well, but I believe it as well. Yeah,
you don't want to get bumped off the train for picking another one. I'm a big fan of the CP. I think they're beautiful red trains that are going through, British Columbia. Something about the backdrop of that. Bill Stevens points out Alaska's got a library too. What's that?
No, it's a good choice. I can't argue with you there, Craig.
I think that big giant red train is just absolutely gorgeous. So my son and I, we've got an O-scale Lionel set. Layout. We got a couple of different ones. We got the John Deere, but the one that I really liked is Lionel rolled out last year, this new CPKC branded train, this library, and that's the one that he seems to like the best. My daughter,
it does pop. The red trains pop for sure.
Yeah, for sure. Beautiful against the backdrop. My daughter's 5. One of my daughters is 5 because I have
they're both
twins.
5.
They're both 5. Yes, and she is obsessed with Rudolph. And I've kind of converted her, from Tennessee, we're a little redneck down here, to she thinks the John Deere stuff is like Rudolph. So she runs around like a little, Tennessee hillbilly. with some John Deere merch on. I love it. It's
Nice.
great. So, Jeff, appreciate you coming back on to FreightWaves Today. We'll have to have you back as we get into peak season. We're going to be watching the intermodals to see how they're performing. Best of luck in your restructuring. If you need a place to park a little bit of that money, that new balance sheet, FreightWaves Today would love to have you as a sponsor.
Yeah. Sounds good, Craig. Hey, I appreciate you guys having me back on.
Appreciate you coming. I love when we get to talk intermodal. It's just such it's a relatively small piece of the overall freight market. It's not as big as I think it gets. I think Wall Street focuses a lot on it because there aren't a lot of big transportation companies, and so the railroads have an outsized attention from Wall Street versus the trucking operations. It's still a small piece of it, but intermodal is a relatively small piece. What's that?
And they make money, so they're
they
fun to
make
talk
money.
about.
They do very well. I mean, you saw how robust JB Hunt's earnings were, and Jeff's got a new balance sheet. He's going to have the opportunity to make money, which they probably obviously had some challenges with a lot of debt that were really in the sort of post XPO days where we did a lot of took on a lot of debt. Now that's restructured. It's got to be a relief.
I imagine so. Yes.
Yeah, I mean, go from
almost like a fresh start. Like, okay, like now what are we going to do? Where do we focus on? Yeah, I mean,
it's an asset-intensive
survival to actually kind of like what we talked about earlier today. Survival to actually focusing on the business, right?
Yeah, you go and you have to be in sort of cockroach mode when you're struggling with all that debt. You can't do anything. You got to survive. It's all about survival. Bankruptcy allows you to redo that, allows you to fix those problems, and then you get to invest in your business.
Yeah.
It's an asset-intensive business, intermodal. Like it is not the way trucking operates. It has its own sort of dynamics, but it is still a very asset-intensive business.
Well, and they do have quite a few truck assets too, right? I mean, they do most of their own drayage. I believe.
I'm not 100%. Jeff would know. I don't know. Do they do their own drayage? Do they used to do their own drayage?
I thought they did.
We'll have to have Jeff on to tell us. So just thinking about, I want to go back to our earlier conversation about this PAM versus Heartland, sort of one company that had some challenging years. I mean, Werner was also in a category of a company during the Great Freight Recessions, the depths of it, that was challenged financially, or not financially, but certainly operationally had some.
Their profitability was not as good as
their OR was above 100%, which is not unusual for a lot of the truckload operators. But what is the deal with PAM? Is it just?
I wonder if it's freight mix in that they haul
automotive
cheap freight.
Freight, yeah. And these automotive contracts, if you have, it's going back to the earlier conversation, if you have such large concentration with one shipper. I remember my dad used to tell me a story where Target was Southwest Motor Freight back in the day. It was the largest customer. It was like a third of their business. And they wanted to ramp up, basically double the amount of freight, and he refused to take the double.
Too many eggs in one basket.
Because you didn't want this high concentration. If it's 30% of your business and you doubled it to, all of a sudden allocating all these trucks to it.
It's too much risk.
They own you. Like there's not much you can do.
And they own the leverage because they know you have.
They don't own you literally, but they have full leverage.
But then you also. Yeah, something changes in their business. I mean, it's too much risk for you.
They put it out for bid, or they decide that they're not going to award you the same lanes. Now you built your whole network on it. It's a tough business. I think that's really where brokers have the advantage because, frankly, let's say that you were to double your business with a large shipper, you're not, because you don't have assets that are in the network. You don't have that risk.
Yeah, I would like to spend some more time going through their earnings and see what I could dig up. I didn't get a feel for like how much of their business is dedicated versus over the road in their truckload and how that might affect their overall rate and empty miles and all of those sorts of things. But that overall rate per total mile of $1.98 is still what stood out to me.
Oh, it's horrible. I think.
And I have no idea what their length of haul is. So their length of haul might be super long, but
still at $1.98 you're running. I mean, Atri, I think the break even last was like $2.26 a mile or something like that. So they're operating at a loss, literally. When you've got a 110 overall, but 114 on truckload. Just a sign that a company that has had certainly not operating at the top of operating frankly very weak. And congratulations to the folks at Heartland. I know that's been a tough couple of years. So probably.
Yeah, well, this is what we want to see for PAM too, right? I mean, this is what we want to see for all of these.
We're rooting for everybody. We want every business to do well. This is one of the things that. We are champions of our industry, and would like to see every company get back on track. Tomorrow, we have another great show of FreightWaves Today. Join us tomorrow at noon. We are going to talk all about, we've got Grip. He's going to talk about the food delivery and what that's like, these meal kit companies. And then we're going to talk about really the overall state of driver pay. That's tomorrow on FreightWaves Today. See you at noon.